Welcome to our discussion on top 3 Canadian dividend stocks worth buying today for passive income. The world of investing can be a complex maze, but one path to financial growth lies in dividend stocks. Today we're focusing on 3 Canadian heavyweights: Enbridge, Canadian Utilities, and the Bank of Montreal. These companies offer promising dividends, making them worth considering for your investment portfolio. Stay tuned as we delve into the specifics of these companies and their annual yields. Hello viewers, if you're enjoying this content and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First on our list is Enbridge Inc., widely known by its ticker ENB. Enbridge Inc. is a leading energy delivery company based in North America. This energy titan operates in the oil and gas sector, specializing in the transportation, distribution, and generation of energy. Enbridge's business model is split into 5 key segments: liquids pipelines, gas distribution, gas transmission and midstream, green power and transmission, and energy services. This diversified approach allows Enbridge to maintain a steady flow of revenue, even when one sector faces challenges. Speaking of market position, Enbridge boasts an impressive portfolio. With the world's longest crude oil and liquids transportation system, Enbridge plays a pivotal role in North America's energy infrastructure. The company transports about 25% of North America's crude oil, connecting key oil patches with refineries and export markets across the continent. But Enbridge isn't resting on its laurels. The company has a robust growth strategy in place, focusing on capital-efficient expansions, renewable energy projects, and the optimization of its existing assets. These initiatives are designed to drive long-term earnings and cash flow growth, reinforcing Enbridge's position in the energy sector. Now let's talk dividends. As a dividend investor, you're probably eyeing those juicy yields. Well, Enbridge won't disappoint you. The company has a track record of delivering reliable dividends to its shareholders. It's one of the few companies that has increased its dividend for over 2 decades consecutively. As of the close of the year 2024, Enbridge offered an annual dividend yield of approximately 7%. Couple this high yield with Enbridge's commitment to dividend growth, and you've got a compelling case for investment. The company's stable cash flows, backed by long-term contracts, provide a solid foundation for these dividends, making Enbridge a favorite among income-seeking investors. With a robust business model and a high annual yield, ENB certainly presents an appealing option for investors seeking passive income. So if you're on the hunt for a reliable dividend payer with a strong market position and clear growth prospects, Enbridge Inc. might just be the ticket. Next up, we have Canadian Utilities Limited, or CU. As one of the largest utility companies in Canada, CU has a prominent position in the industry. With a rich history that dates back over a century, CU has been a steady fixture in the Canadian landscape. It operates in a diverse range of sectors, including electricity, pipelines and liquids, and retail energy, offering a balanced portfolio to investors. CU's industry position is marked by its unwavering focus on delivering reliable and affordable energy services. Its vast infrastructure, spanning across Canada, Australia, and Latin America, is a testament to its global reach and robust operational capabilities. This broad geographical footprint not only diversifies CU's revenue stream, but also provides a cushion against regional market volatility. The company's growth potential is another aspect that makes it stand out. CU continually invests in innovation and infrastructure development, ensuring its services remain relevant and competitive. For instance, in recent years, the company has been focusing on renewable energy projects, responding to the global shift towards clean energy. This strategic move not only aligns with environmental responsibilities but also opens up new avenues for revenue generation. But what makes CU particularly attractive to dividend investors is its annual yield. For years, CU has maintained a consistent track record of paying dividends. As of the end of the previous year, CU offered an annual dividend yield of around 4.5%. This steady dividend payout, coupled with its capital appreciation potential, provides a compelling total return proposition to shareholders. Moreover, CU's commitment to its dividend policy is underscored by its dividend increase streak. The company has consistently increased its dividends for nearly 5 decades, demonstrating its commitment to returning value to its shareholders. In conclusion, CU's strong industry position, growth potential, and consistent dividend payout make it an attractive choice for dividend investors. Its diversified operations, strategic investments in growth areas, and robust dividend history underscore its stability and commitment to shareholder returns. CU's steady growth and attractive dividend yield make it a noteworthy consideration for any dividend investor. Last but not least, let's examine the Bank of Montreal, commonly referred to as BMO. Established in 1817, BMO is not only the oldest bank in Canada, but one of the largest too. This financial institution has a robust presence not just in Canada, but also in the United States, giving it a broad customer base and a diverse revenue stream. Let's dive into the bank's standing in the industry. BMO is considered one of the big 5 banks in Canada, a testament to its strong market presence. Its extensive network includes over 900 branches, serving more than 12 million customers. The bank offers a wide range of financial services, including personal and commercial banking, wealth management, and investment banking products and services. Now let's touch on BMO's growth prospects. Despite the challenges posed by the global pandemic, BMO's resilient business model and prudent risk management have allowed it to weather the storm. As we look to the future, the bank is strategically positioned to capitalize on growth opportunities, especially in its U.S. personal and commercial banking and BMO capital market segments. And of course, we can't forget about dividends. BMO has a storied history of paying dividends, a streak that has continued for over 180 years. Yes, you heard it right. BMO has never missed a dividend payment since its inception. As of today, the bank offers an annual dividend yield of around 4%, one of the highest among its peers. This makes it an attractive choice for income-seeking investors. In summary, BMO's robust market position, promising growth prospects, and consistent dividend payout history make it an excellent pick for those seeking both growth and income. The bank's ability to deliver strong financial performance while offering a competitive dividend yield underscores its commitment to generating shareholder value. BMO's strong market presence and competitive dividend yield certainly make it a strong contender for your investment portfolio. Now that we've examined each company individually, let's see how they stack up against each other. Our first contender, Enbridge, is a titan in the energy sector. It boasts a remarkable track record of consistent dividend payouts, even in the face of fluctuating oil prices. This is largely due to its diversified business model, which spans across multiple energy segments. However, it's important to remember that the energy sector is inherently volatile and subject to regulatory hurdles. Therefore, Enbridge's performance can be influenced by factors beyond its control, such as geopolitical tensions and environmental regulations. Moving on to Canadian Utilities. This company offers a unique blend of stability and growth. With a diversified portfolio of utility assets, it's able to generate steady revenue streams, translating into consistent dividends for investors. Its long-term contracts and regulated returns provide a buffer against market volatility. But it's worth noting that the company's heavy reliance on the regulatory environment could pose a risk if there are significant policy changes. Finally, let's talk about Bank of Montreal. As one of the oldest and most respected financial institutions in Canada, BMO offers a compelling dividend yield, backed by a robust financial performance. Its diversified revenue streams, spanning personal and commercial banking, wealth management, and capital markets, contribute to its resilience. However, the banking sector isn't without risks. Economic downturns, interest rate fluctuations, and loan defaults could impact BMO's profitability. In summary, Enbridge offers a high yield and resilience in a volatile sector. Canadian Utilities provides stability with its regulated returns, and Bank of Montreal presents a balanced mix of yield and growth in the financial sector. It's crucial to consider these strengths and weaknesses alongside your personal investment goals and risk tolerance when building your dividend portfolio. As you can see, each of these companies brings unique strengths to the table, making them worthy of consideration for your dividend portfolio. Investing in dividend stocks requires a strategic approach. That's something we've all heard, right? But what does it really mean? Let's delve into it. First off, we can't stress enough the importance of diversification. It's the golden rule of investing. Don't put all your eggs in one basket. By spreading your investments across a variety of stocks, you minimize the risk of any single stock's poor performance significantly impacting your overall portfolio. And when it comes to dividend stocks, diversification means investing in companies from different sectors with varying dividend yields and growth rates. Now let's talk about reinvesting dividends. This is a powerful strategy that can significantly boost your investment returns over time. When a company pays you a dividend instead of taking it as cash, consider reinvesting it back into buying more shares of the company. This way, you're effectively compounding your returns. You're earning dividends on your dividends. It's a snowball effect that can lead to substantial growth over the long run. And finally, remember that dividend investing is a long-term game. It's not about making a quick buck. Companies that consistently pay and increase their dividends are often stable, well-established businesses. They may not offer the rapid growth that some riskier stocks promise, but they provide steady, reliable returns. It's about patience and sticking to your strategy, even when the market gets turbulent. But let's not forget, investing always comes with risks. While these tips can guide your strategy, it's crucial to do your own research and consider seeking advice from a financial advisor. One last tip before we wrap up. Keep an eye on dividend payout ratios. This is the percentage of a company's earnings it pays out as dividends. A high ratio may not be sustainable in the long run, and a sudden cut in dividends can negatively impact the stock's price. By following these strategies, you can maximize your passive income from dividend stocks. Remember, investing is a journey, not a destination. So take your time, make informed decisions, and let the power of dividends work for you. In conclusion, ENB, CU, and BMO represent some of the top Canadian dividend stocks worth considering today. Remember, Enbridge offers a stable yield backed by a robust energy infrastructure. Canadian Utilities, with its consistent performance, presents a reliable choice. Lastly, Bank of Montreal, with its impressive track record, shines as a strong option. These companies not only promise steady income but also potential capital appreciation. Remember, the key to successful investing is research, patience, and a well-diversified portfolio. We hope you found this information on Canadian dividend stocks useful and insightful. It's always important to keep in mind that investment is not a one-size-fits-all strategy. Everyone's financial goals and risk tolerance varies. That's why we encourage you to take this information as a starting point to begin your own deep dive research. Don't hesitate to reach out to professionals. A financial advisor can provide personalized advice based on your unique circumstances. They can help you determine if Enbridge Inc., Canadian Utilities Limited, or Bank of Montreal align with your investment strategy. Remember, the quest for passive income is a marathon, not a sprint. It takes time, patience, and informed decision-making. With a solid plan and a diversified portfolio, you're already on the right track towards financial freedom. Don't forget to subscribe, like, and share this video to stay updated on the latest investment trends. Thank you for watching.